Welcome back to the channel, and in this video we're going to talk about the big question: who pays more taxes? Is it the dividend investor that focuses on getting a regular monthly to quarterly income, or is it the capital gain investor who focuses on momentum and hype stocks? And this question, who pays more taxes, will impact how you plan for retirement, and it will also impact how you think about the kind of investor you want to be. Because at the end of the day, what you're really maximizing for is the after-tax gain from your investments. And doing that, you can grow your portfolio faster. Doing that, you can retire earlier and live a more comfortable and less stressful life. So let's get started. So who pays more taxes? Dividend investors or capital gain growth investors? And this video is really a part of a larger series where we look at how to calculate capital gain for US and Canada, how does trading frequency changes the amount of taxes you pay, to some tax planning strategies where you can save thousands of cheeseburgers a year. And if you are interested in those other topics, then make sure you go back and watch those videos, or it will be released at a future date. So before we start, I just want to celebrate another case study within Investing Accelerator where Mike made 151% from FedEx in 3.5 months using stock options. So congratulations, Mike. That is a fantastic return and good job. And Dexter also sold his FedEx options for 90% gain in 7 months. Again, another amazing return. Congratulations, Dexter. Now, if you want to learn more on how to become a smarter investor, how to be more confident when it comes to investing, and make a higher return long term, then this channel is right for you. So if you tap the subscribe button, then you'll get notified when I release future videos around these topics like taxes, emotions, how to handle when you're dealing with losses, and so on. In terms of the 100 likes giveaway, I'm currently giving away a book called Rich Dad Poor Dad. It's one of my favorite personal finance books, and if you like this video and leave a comment below, when we reach 100 likes, I'll select a winner. So let's look at the scenarios that we'll go through today. Assume you have a portfolio of $100,000 and you either make $30,000 in capital gain or $30,000 in dividend. In the first scenario, you have $200K in income. And I'm using $200K because that is the highest tax bracket you can get. So that makes it simpler. And you make $30K of dividend or capital gain. In scenario 2, I use $70K of income. So that means you're kind of in the average salary of Canada. And again, $30K of dividend or $30K of capital gain. And in the third scenario is $0 in income. Maybe you're retired. Maybe you just have a lower income with $30K of dividend or $30K of capital gain. And this is the calculator I'm using. And I already took screenshots, so we can just jump straight into the results. So before we do that, we need to understand a couple of concepts. When you are looking at the CRA tax handbook, there are 3 main important type of dividends. The first one is eligible, second one is non-eligible, and the third one is capital dividend. Now you might be wondering, what are these? Like, why is it so complicated? And how does that impact the amount of taxes you're paying? So we'll walk through each one of them right now. Eligible dividend are generally received from public companies. So that's very simple. If you invest in a stock from Toronto Stock Exchange, you pay eligible dividends. Non-eligible dividends are generally received from Canadian private corporations that have paid lower tax rates on the first $500,000 of income. Now, this generally does not apply to you unless you have your own business. When you have your own business, your business profits get taxed, and then you can pay out a dividend to yourself. So that's why it gets a different rate than eligible dividends. So for most of the time, if you don't have a business, this wouldn't apply to you. So we're not going to focus on that in this video. The third one is capital dividend. Now, sometimes when a corporation realizes a capital gain, one half of the capital gain is taxable and the other half is not taxable, which I cover in a separate video called capital gain, and is added to what's known as a capital dividend account. So this is kind of important because if you sell a property, you pay capital gain. if the corporation sells a property and then pays you dividend, you don't get taxed on that dividend because the corporation already paid capital gain. So that's a very important distinction. And most of the time, when you are getting dividends from public companies, it's going to be the first one. It's going to be eligible dividend, and that's what we're going to focus on in this video. Now, just so you know, these are the tax rates. Now, these are rule of thumbs, and you need to really calculate your specific situation using the tax calculator. And I'll leave that in the comment below. Capital gain in Canada, it's 25%. For eligible dividend, it's 39%. It's quite high. For non-eligible dividend, is 45%. And for capital dividend is 0%. And the reason is because the corporation already paid capital gain tax. Okay, so let's dive into the scenario. Now let's say you have a portfolio of 100K and you either make 30% in capital gain or 30% in dividend. Now it actually makes more sense if I say $30,000 in capital gain or $30,000 in dividends, because it is extremely rare that you can make 30% in dividend. I've never seen it, so just imagine it is $30,000 in capital gain or $30,000 in dividend. We wouldn't look at the efficiency of the capital invested in this video, so we'll just keep the constant in terms of dollar amount, in terms of the amount of dividend and capital gain. Now the first scenario, you're at the highest tax bracket. And in this case, you'll see that on the left-hand side, you get dividend, and your total tax bill comes to $77,815. Wow. And on the right-hand side, your tax bill comes to $75,068. In an interesting scenario like this, you actually pay more taxes by being a dividend investor. And that's actually 9% of 30K. So 9% of your gain is towards taxes. So when you're making a high income, depending on which stage of the career you're in, it's actually disadvantageous to you to be a dividend investor. Even though a lot of people tell you that you should be a dividend investor because you're getting monthly income, blah, 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 blah. But the result tells you that you pay more taxes. So you might want to rethink your strategy if you are making a very high income right now. Now, before I jump on to the 70K scenario, let me just go back and mention an additional tip. When you're looking at capital gain and dividend, and if you are making a high income like 200K, you really need to think, do I need the money right now? And this is a very important concept, because if you don't need the money right now and you are reinvesting the dividend, then why bother paying the tax now when you get dividend each year or monthly, quarterly, and then reinvest it back into the company you want to invest in? That's a bit counterintuitive because you're paying more taxes, and that actually slows your portfolio growth down. So if you are making a high income and you are okay with leaving the money in the stock for multiple years, then you should focus on capital gain, because the analysis I'm doing here is actually just 1 year. But what you really want to think about is the next 5 to 10 years, because year after year, if you are a dividend investor, you get tax and tax and tax, whereas capital gain, you keep compounding and you only get taxed at the very end when you exit, assuming you're not a day trader. So when you think about that, it is actually more advantageous to be a capital gain investor when you are making such a high income, because you don't need the money immediately. So let's jump on to the second scenario. 70K income with 30K dividend, and that's when you pay $18,554 in taxes. And 70K income with 30K of capital gain, and you actually pay $20,500 in taxes. So you actually pay more when you are investing as a capital gain growth investor. And how much more? It's really 6% of $30,000, which is $1,946 less in taxes for being a dividend investor. Now, this is actually very interesting. Like, why is that? When I first did the scenario analysis, I wasn't really understanding why that is the case, because why does it flip over? And let's look at the third situation first, and this will give you a better idea of what's happening. Imagine you are retired, and now you don't have any pension, you don't have any income, and you just get 30K of dividend, or you get 30K of capital gain. And in this case, for 30K of dividend, you actually pay $0 in taxes. And 30K of capital gain, you actually pay $471 in taxes. So in a way, again, it is better to be a dividend investor by having less income. And when you think about this third scenario, it's important to think about when you need the money. Because when you look at capital gain, it is really what we call paper gain. That means you don't actually get the cash, it's kind of still locked in the shares, and it's just a share price going up. But for dividend, it actually gets paid out. So it becomes cash in your portfolio. And if you want to take that out and you want to spend it on something, you don't need to sell any shares. The number of shares you still have is the same. So when you are trying to be a dividend or a capital gain investor, you need to think about where you are in life. Are you trying to take money out of your portfolio? Are you trying to grow your portfolio to $1 million? That distinction should push you either to become a dividend investor or a capital gain investor. Now, here is the answer to the question earlier. Why does it flip between being a capital gain investor versus a dividend investor? And in Canada, there is a concept called the marginal tax rate. So that means depending on how much money you're making, your tax rate is different. So on the right-hand side here, you actually see the table I got for you. And this is for federal tax, where you can see that in the first $49,000, you actually have 0% tax for eligible dividends. And that's actually quite interesting. And for the first $49,000, you actually have a 7.5% of capital gain tax. Now, this is just federal. Remember I said the rule of thumb for capital gain is around 25%. So you got to combine it with provincial as well. But if you follow this logic, you will see that initially up to $89,000, you will pay more tax as a capital gain investor instead of a dividend investor. And once you get over 200K, which is 216K, then suddenly dividend investor will pay more taxes. Now, if you actually look at this carefully, after 98,000, dividend investors already pay more taxes. But the scenarios I showed you are actually in here, the red box, and this lower red box as well. And that's what I mean. So if you are a high income earner, it's better for you to invest and aim for capital gain because you don't need to take it out immediately. The tax rate is lower, so on and so forth. If you're retired and you have a lower income and the percentage return you're making for capital gain and dividend is around the same, so let's say 10%, then it's better for you to be a dividend investor because you save this 3 to 7% in taxes. Now here is the big question. If you become a capital gain investor instead of a dividend investor, can you make a higher return? Now for dividend investor, I really see people making around 4 to 7% a year. Now sometimes the dividend can be lower depending on which stock you invest in, like 2, 3%. So it's not a lot of return. And for capital gain investor, I have seen people going from 8 to 10%, which is the market average, to 10 to 15%. So that range is not something a dividend investor can easily achieve. It's not saying that it's impossible, but it's just difficult for you to find a dividend investment that is 10 to 15%. Now, some people can do higher risk mortgages that gives you around 10% return, but I would say those people are very rare when it comes to watching my YouTube channel per se. So if you factor in the incremental return you get from capital gain versus the dividend return and you calculate the after-tax amount using the calculator down below in the link, I'll include it, then you can decide whether you want to be a dividend investor or a capital gain investor. And at this point, I just want to share my vision with you. And my vision for myself is really to make 30% a year. Actually, I've achieved this goal this year. I'm only 1 month away from December 31st, and I have made more than 30% this year so far, even though there's COVID. And my journey from 0 to 30% a year is really a difficult one. I learned investing by myself. For 8 years, I tried 300 different strategies. I learned programming, and investing used to be a black box to me. And I was spending 30, 40 hours a week on learning about investing, reading books, blog posts, watching YouTube videos. And now I master investing and I realize investing is actually very simple. You got to have all the right parts. Now I help people to master investing in 4 weeks and I transfer all of my knowledge to them so they can become a successful investor as well. And these are the case studies within Investing Accelerator where Mike made 151% from FedEx in 3.5 months. Dexter made 90% from FedEx in 7 months. And they actually have recorded a video testimonials for me as well, so you can watch that if you want to. And if you want to learn more about my investing strategy on how I use long-term stock options to invest in the market, then you want to click on the first link below called Free Webinar, How to Get 30% from the Market in 12 Months. It should be the very first link, and when you register for it, you'll be taken to a 4-hour webinar. Take your time to go through the webinar, and afterwards, if you're interested, then you can schedule a call with me, and we'll have a 45-minute chat, and I'll answer any questions you have about investing, and we'll map out exactly what you need to do in order to move forward and target a higher return a year. So I look forward to chat with you. Now, in terms of the next video, I have prepared an interesting topic called Are you working too hard as a day trader and paying too much in taxes? So I'll see you in the next one.